Hello, and welcome to Trestlebridge Capital's Know What You Own series. Before we begin, here's a quick note from our legal team. Leading today's discussion is Eric Jefferson, Managing Partner at Trestlebridge Capital, as he walks through recent holdings changes. Let's get started.
Well, thank you for taking the time to join us and want to share about a change we recently made in the portfolios, taking advantage of what I believe to be a very attractive entry point. This was a managed floor ETF or exchange traded fund, and want to provide some context on that. A newer type of investment approach as the ETF industry has continued to evolve. You've seen managers try and work a little harder and smarter to take advantage of all the different tools, instruments, and techniques out there to hopefully at the end of the day create more favorable client outcomes. With managed floor ETFs, this is a strategy where managers will exchange or trade a portion of upside gains for protection against tail risk or extreme double-digit market declines. Based upon current environment today, we thought this offered a very attractive risk-return profile. So how does this work? On the left-hand side of the screen here, you can see a hypothetical return stream for the S&P 500. In the middle there, you can see how these managed floor ETFs are expected to perform. You can see in a positive in market, so any returns plus 1% up to 30 as we illustrate here, investors would expect to receive about 70 to 80% of those returns. So in an environment where the S&P is up 10, as a managed floor investor, you'd expect to earn about 7.5%. In exchange, as you can see moving down, if markets are volatile, particularly if they've reached a floor of 10% or greater market declines, investors would now fall into that protection umbrella highlighted there in yellow, essentially mitigating any further market drawdowns. So we think about the risk-return trade-off today, given the extreme sell-off that markets experienced very, very quickly here. Most of these instruments currently in that protection zone, suggesting that if the data were to soften, if tariff policy was not as pronounced as expected or hoped, if markets did continue to decline further, investors would be fairly isolated from that volatility in these instruments. In exchange, they're able to earn 70 to 80% of any upside gains depending upon where we go from here. And now obviously these instruments will reset over time, but from a tactical standpoint, I thought this was a very attractive risk-return trade-off. Again, markets are rallying higher here to start trading on Tuesday the 8th, but nonetheless do still represent a number of risks out there. And so the ability to earn a vast majority of upside in exchange for not worrying about any downside volatility, given where we are today, thought that was a very attractive entry point and thus something you will now see reflected in your portfolios.